What is the single biggest lie the trading world has ever sold you? It's that you need money to make money. That without a huge account, you're just gambling. That without a fortune, you can't build one. Today, we expose that lie. We're going inside the minds of two men who started with almost nothing, just a few $100s, and built empires. This isn't just about charts and profits. This is a deep psychological study of how ambition, when funneled through discipline, dismantles every barrier. If you've ever felt stuck because your account is too small, this video is your blueprint. Smash that like button and hit subscribe, because we're about to rewrite your trading psychology from the ground up. We live in a culture obsessed with the overnight success story. The narrative is always about the moonshot, the one-in-a-million trade that breaks the internet. We glorify the lottery win and ignore the slow, steady, and psychologically arduous path of building genuine, sustainable wealth. This obsession is not just misleading, it's psychologically destructive. It programs the average person to believe that if they haven't doubled their account in a month, they have failed. This is where the stories of Ross Cameron and Tim Grittani become so critically important. They are not case studies in luck. They are masterclasses in the power of a paradoxical mindset, the ability to start with microscopic, manageable sums of capital while simultaneously nurturing a macroscopic, limitless vision for future. The genius of beginning with a small account, something in a range of $500 to $1,500 as they did, is profoundly psychological. A small account is a laboratory, not a casino. When you are risking amounts that, if lost, will not destroy your financial stability or your emotional well-being, you create a safe space for the most valuable commodity in a trader's journey: failure. Every loss becomes a data point, not a disaster. It becomes a lesson to be analyzed, not a trauma to be repressed. This is an environment where true learning thrives. You can experiment with different strategies, test your emotional reactions to drawdowns, and refine your risk management without the paralyzing cloud of fear hovering over you. The small account size acts as a psychological safety net, allowing for the curiosity and experimentation that are absolutely essential for growth. This is the antithesis of the trader who takes a second mortgage or risks their life savings on a sure thing, placing themselves under a weight of psychological pressure so immense that every tick against them feels like a catastrophe, clouding judgment and guaranteeing impulsive, emotional decisions. But here's the critical nuance that most miss. Starting small does not mean thinking small. This is the delicate balance they mastered. The small account was a tool, but the vision was everything. They weren't just trying to make $50 a day. They were building a system. They were focused on percentages and consistency, not absolute dollar amounts. Their goal wasn't to turn $500 into $1,000 quickly. It was to develop a process that could generate a 5% return per month with rock-solid consistency. They understood a fundamental mathematical truth. Consistent, positive returns compound. A 5% return per month doesn't sound glamorous, but will turn $1,000 into over $100,000 in 5 years. They were playing a completely different game, the game of exponential growth, which is a game of patience and process. This mindset requires a profound shift in self-perception. Ross Cameron, when he was trading with $500, wasn't seeing himself as a guy with a $500 account. Psychologically, he was already a fund manager. He was practicing the fiduciary responsibility, the risk management, and the strategic patience he would need when that account was $500,000. He was building the neural pathways and behavioral habits of a successful trader first, trusting that the capital would follow the competence. This is the core of the Think Big principle. It's about embodying the identity of the trader you aspire to be now, regardless of your account size. Your actions are not dictated by the capital you have, but by the capital you are preparing to manage. This mindset eliminates frustration, impatience, and the temptation to over-leverage. The account on the screen is simply a scorecard for how well you are executing the system you are building for your future self. The real asset being built wasn't a brokerage account. It was between their ears, a robust, tested, and unshakable trading psychology forged in the safe, low-stakes fires of a small beginning. They didn't trade to get rich. They traded to get good, knowing with unshakable certainty that getting rich will be the inevitable byproduct. The allure of the fast money, the life-changing trade that happens overnight. It's a siren song that has wrecked more trading accounts than any market crash ever could. This desire for instant gratification isn't just a bad habit. It's a fundamental neurological wiring. Our brains are conditioned to seek immediate rewards, a trait that was essential for survival millennia ago, but is utterly destructive in the modern financial markets. This is why the second pillar of the success we see in traders like Cameron and Grittani is so counterintuitive and so psychologically demanding. The unwavering commitment to consistency over get-rich-quick. They didn't just avoid the lottery ticket mentality. They built a psychological fortress against it, understanding that true wealth is not a singular event but process, a slow and deliberate accumulation of disciplined actions repeated day after day, week after week, regardless of market conditions or emotional temptations. This philosophy manifests most clearly in the sacred practice of routine. For them, trading was not something they did when they felt like it or when the stars seemed to align. It was a non-negotiable daily profession. This meant having a pre-market ritual of analysis and planning, defined hours of intense focus during market hours, and a post-market routine of review and journaling. This structure does something remarkable to the human mind. It automates discipline. By removing the need to decide whether to do these things, they conserve precious mental energy for the only thing that mattered, making good decisions during the trade. It's the psychological equivalent of a professional athlete's training regimen. You don't decide every morning if you feel like practicing. You just practice. This relentless consistency builds what psychologists call procedural memory. The trades, the risk management, the emotional control all become second nature, embedded deep in the subconscious, so that during moments of high market stress, the correct response is automatic, not a frantic, emotional debate. Furthermore, this focus on consistency completely reframes the concept of loss. In the get-rich-quick model, a loss is a catastrophic failure, a verdict on one's ability, a reason to quit or to desperately revenge trade to win it all back. But within the consistency model, a loss is simply feedback. It is an inevitable and necessary data point in the lifelong process of refining one's edge. A week of breaking even isn't a wasted week. It's a successful week because capital was preserved and lessons were logged. This shifts a trader's entire identity from being a winner or a loser based on daily P&L to being a process follower. Their self-worth becomes detached from the uncontrollable outcome of any single trade and is instead tied to controllable input of their preparation and execution. This is an incredibly liberating psychological place to operate from. It eliminates the roller coaster of ego and despair and replaces it with a calm, steady, and clinical approach to the markets. The most powerful psychological weapon in their arsenal, however, was their understanding of compound growth, not just as a mathematical concept, but as a behavioral one. The get-rich-quick seeker is focused on addition, on the next big score. The consistent process followers focused on multiplication. They knew that a 3% gain this week and a 5% gain the next might seem small, even boring. But they also knew that stringing together enough of those weeks would create an exponential curve that would eventually dwarf any single lucky trade. This long-term perspective is a direct antidote to impulsivity. It allows a trader to sit on their hands and do nothing for days on end, waiting for only their highest probability setup, because they are not fighting the anxiety of needing to make money today. They are playing a longer, more sophisticated game where the ultimate goal isn't to have a few good days, but to have a genuinely prosperous life, built on a foundation of unshakable habit and psychological resilience that no single market event can ever take away. And this relentless focus on process, this daily dedication to the grind, naturally leads us to the very engine of their success, the true differentiator that separates those who burn out from those who build lasting legacies. We've talked about the external actions, the routines, the journaling, the patience. But none of that is possible without mastering the internal landscape. This is the core of the third principle. Master your mind, not just the market. Ross Cameron and Tim Grittani could have had the same charts, the same scanners, the same data feeds as every other trader. Their ultimate edge wasn't informational. It was transformational. It was their ability to engage in a constant, vigilant negotiation with their own deepest psychological instincts, to recognize the primal urges of fear and greed not as commands to be obeyed, but as data points to be acknowledged and managed. They understood that the market is a neutral entity. It doesn't have a vendetta against you. nor is it your friend. It simply is. Therefore, the only thing a trader can ever truly control is their reaction to it. The battle for profits is won or lost not on the screen, but in the 6 inches between your ears. Consider the most common psychological traps. There's FOMO, the fear of missing out, that gut-wrenching anxiety that everyone is making money except for you. It's a powerful impulse rooted in our tribal past, where being left behind can mean literal peril. In trading, this manifests as chasing a stock that's already rocketed 80%, entering a trade without a plan simply because you can't stand watching it go higher without you. Then there's its vicious counterpart, revenge trading. This is the ego's response to a loss. The pain of being wrong triggers a deep-seated need to immediately prove yourself right again, to wrestle back control. This leads to jumping into another trade, often larger in size, right after a loss, seeking not a high-probability setup, but emotional restitution. Both FOMO and revenge trading are emotional hijackings. They bypass the logical, strategic part of the brain and hand control over to the amygdala, the center for fear and aggression. Cameron and Grittani became adept at spotting these hijackings in real time. They developed a kind of mental alarm bell that would ring when they felt that specific surge of panic or that hot flush of prideful anger. And instead of acting on it, they had trained themselves to pause. That pause is a superpower. Their mastery extended to a more subtle cognitive trap, confirmation bias. This is our brain's tendency to seek out and prioritize information that confirms what we already want to believe. If you've taken a long position on a stock, your mind will naturally magnify every bullish article and dismiss every piece of bearish news. You'll ignore breaking negative news or a weakening chart pattern because you are emotionally and financially committed to being right. This is perhaps the most insidious enemy of objective analysis. The way they combated this was through systematic, rules-based trading. By predefining their entry points, their profit targets, and their stop-loss levels before ever entering a trade, they created an objective framework. The rule was the boss. This system acted as a circuit breaker for their emotions. It didn't matter if they felt hopeful about a trade. If the price hit the preset stop-loss, the trade was closed. Period. This mechanical adherence to a plan stripped the power away from their biased emotions and forced a discipline that protected them from their own blind spots. They weren't trading to feel smart or to be right. They were trading to make objectively sound decisions, and they respected their system more than they trusted their fleeting feelings. This is the ultimate psychological shift. From needing the market to validate you, to using your system to evaluate the market. And this rigorous system, this rules-based approach to stifling emotion, leads us to the final, and perhaps most transformative, habit that cemented their journey from hopeful beginners to market masters. We've established that the battle is internal, a constant negotiation with primal instincts. But how does one actually win that battle? How do you move from knowing what to do to consistently doing what you know? The answer lies in the fourth cornerstone of their psychology: learn publicly, trade privately. This is a deceptively simple concept with profound implications. For Cameron and Grittani, learning was not a passive, private activity. It was an active, often brutally honest, process of externalization. They didn't just experience losses quietly, they dissected them. They maintained exhaustive trading journals. But these weren't mere logs of profits and losses. They were deep psychological autopsies. Every entry forced them to answer uncomfortable questions. What was my exact rationale for this trade? What emotion did I feel at the moment of entry? Was it confidence based on my strategy, or was it FOMO? Did I deviate from my plan? Why? How did I feel when the trade moved against me? When it moved in my favor? This act of writing it down transforms a vague, painful memory into a concrete, analyzable data point. It objectifies the subjective. A loss is no longer a dark cloud of failure hanging over you. It becomes a specific case study with clear lessons on what neural pathway to avoid in the future. This is how you build self-awareness, by holding a mirror up to your own decision-making process and refusing to look away. But the learning often went beyond the private journal. Both traders immersed themselves in communities, first as students and later as mentors. This is the learn publicly part. Engaging with a community does two critical things. First, It shatters the illusion of isolation. Every trader feels the sting of a loss, the tug of greed, the paralysis of fear. Hearing others vocalize these exact same struggles normalizes them. It reassures you that you are not uniquely flawed or incompetent. You are human, and you are facing the same psychological challenges every single successful trader before you has had to conquer. This reduces the shame and stigma around losing, which is essential for moving past it constructively. Secondly, articulating your reasoning to others, explaining a trade idea, defending a thesis, or admitting a mistake, forces a level of clarity and accountability that private thought can never achieve. When you have to explain why you did something, you often discover there was no good why at all. This process exposes sloppy thinking and rationalizations before they can cost you more money. It turns your trading into a craft honed not in a vacuum, but in a workshop with the feedback and shared wisdom of peers. Yet, for all this public learning and community engagement, the actual act of trading remained an intensely private, almost sacred responsibility. This is the crucial balance. Trade privately. After all the discussion, after all the planning and analysis, the final decision to click the buy or sell button was theirs, and theirs alone. They never outsourced their conviction to a chat room or a guru. The noise of the crowd, the hype, the panic, the conflicting opinions, was intentionally filtered out when it came time to execute. They understood that while community is invaluable for learning and support, it is poison for execution. Following a crowd into a trade is the antithesis of having an edge. It's just herd mentality dressed up as investing. So they would do their research, they would participate in the discussion, but then they would retreat into their own mental fortress, consult their own plan, and make their own call. This cultivated a profound sense of personal accountability. There was no one else to blame for a loss, and no one else to thank for a win. This ownership is a bedrock of genuine confidence. It's the quiet, unshakable assurance that comes not from following a winner, but from having followed your own validated process, win or lose. This is a complete psychological cycle, using public discourse to learn and challenge your ideas, then using private discipline to execute your refined plan, and finally using personal journaling to close the feedback loop and begin the process all over again, forever getting stronger, wiser, and more emotionally resilient. So, what was the real secret? Was it a hidden indicator? A magical formula? As we've seen through the journeys of Ross Cameron and Tim Grittani, the answer is a resounding no. Their stories, though unique, were built on the same unshakable psychological foundation. They understood that starting small was the ultimate strategy to learn without fear. They embraced consistency as their compass, choosing the slow, steady path of process over the chaotic gamble of quick riches. They dedicated themselves not to beating the market, but to the far more critical task of mastering their own minds, disarming the emotional time bombs of fear, greed, and ego. And they committed to learning publicly but trading privately, building accountability through community and wisdom through relentless self-reflection. They didn't trade to make money. They made money because they mastered the art of trading. The profits weren't the goal. They were simply the inevitable byproduct of a psyche that had been trained for excellence. The market doesn't change. Human nature does not change. The same opportunities that existed for them exist for you right now. The only variable is your willingness to do the inner work. This is where we turn theory into action. This isn't just inspiration. This is your call to arms. Your journey begins not with a trade, but with a choice. If this video added value to your mindset, pay it forward. Smash the like button right now. It tells the algorithm this is content that matters. Subscribe to Whispers of Psychology and turn on notifications. We don't just talk about charts. We decode the mental frameworks you need to win, not just in trading, but in life. This is the most important step. Your opinion is our data. In the comments below, I want you to answer this question. Which of these 4 principles, starting small, consistency, mastering your mind, or learning publicly, is the hardest for you to implement and why? Let's start a conversation. Your struggle is not unique, and the solution starts by talking about it. The market is waiting. But now, you're not approaching it as a gambler. You're approaching it as a psychologist, an architect of your own destiny. This is Whispers of Psychology. Until next time, trade smart, but master your mind first.